Thanks for tuning into Talking Point. Our guest today, Ayaz Motiwala, Senior Fund Manager at Nivalis Partners. Ayaz, great having you as always. Thanks for taking the time out. Neeraj here. Ayaz, the street is completely divided about whether the government's focus over the course of this budget and the next few days, weeks, months will continue to remain Capex, or will there be a bit of consumption focus coming in? We've seen some signs of rural recovery commentary in companies at the end of Q4, but nothing quite substantial there. How do you look at this conversation from an equity investor's lens?
Good morning to you, Neeraj, and it's a pleasure always to be on this show. Let me start off by saying that I think the first thing that is on an immediate basis that comes to us as investors' perspective is a potential that the government has to do something in the budget in terms of tweaking a little bit of the income tax rates, maybe corporate rates as well, which is being talked about as such. So I think the pointed answer to your question is hopefully there's something in the budget for the common man or the tax-paying common man, so to speak, one. And then the broad-based taxation that is indirect taxes such as sort of GST, there could be some tweaks and reliefs there as well. Indeed, if the states get together on the fuel side of it, and then once they have a rationalization there, that could be meaningful cash potentially in the hands of the average consumers. That I think is on a here and now sort of immediate thought. I think longer term, the provision of employment through high impact sort of industries which provide a lot of jobs, such as even the creation of infrastructure, which you talked about, and capital investments, and then services industries such as, say, tourism, which is a big agenda on the part of the government, where the employer or the employment multiple is quite high. And that is some of the thoughts that we have.
Got it. Okay. So are you therefore, Ayaz, would you therefore tilt your portfolios a lot more towards consumption now than what they may have been, say, 6 months ago?
Yeah, absolutely. A little bit of that is being sort of indicated even in the stock movement, if you were to notice, right? So it seems, I speak for ourselves, but I think other participants too have done a early round of a little bit of allocation, maybe potentially, and as these, I would say, as this kind of hopeful situation translates into actual numbers. Talk about the sort of rural recovery, talk about volume growth coming back for industries and a more steadier environment in terms of raw material situation, and thus pricing and inflation. If you combine all of those, it seems the outlook on a 12-18-month basis seems to be getting better, even before any of these potential, sort of actions by the government to further, jumpstart on the consumption side versus the investment orientation that has been the case for the last 3-5 years.
Got it. Okay. Ayaz, what suffers as a result? I mean, the pattern to play out Capex themes over the last 12 months was to price out companies which had these niche Capex capabilities, automation modes, the likes of ABB, Siemens, etc. I'm just using them as illustrative examples, and price them to perfection while some of the others were not. Now my question to you is, if indeed the focus of an investment manager, maybe even the government, shifts a bit towards consumption and move away a little bit from Capex, do the high price stocks suffer, or do you believe they will anyways get the earnings because of capex happening in niche areas, but the lower priced ones will continue to languish, or lower valuation ones will continue to languish, I mean?
Yeah, I mean, this goes back to even a 3-5 year situation. If you were to look at that, so it's not that the PSU banks, the other sort of defense-related, PSU largely, but some private companies, and then the capital investment that you talked about have come about in the last 3-6 months or a year, right? So I think the exact opposite, where the investors have chipped away from, let's say, telecoms, IT services, consumption, a decent amount from sort of larger size financials, such as as they're called, corporate banks, etc., uh, and tweak their portfolios. So I guess it will be more of the same as investors sort of go by, and where they sense the opportunity to build their portfolios with you know, forward perspective on a potential recovery in consumption, while the investment argument sort of continues. So it's not a, it'll be a little bit of a chop and churn rather than sort of a massive replacement in the next 12 months as well. Because I think the evidence of this will not be, at a press of a button and suddenly all consumption and all companies will recover and start probably posting 10% volume growth and 17-20% revenue growth. I think we are fooling ourselves if you want to think that way. Uh, but it'll be clearly bottom up from a single stock perspective. But as a sector, I think the sense will be of an improved outlook and an optimistic outlook where the numbers will play out. I think going easily 18-24 months out. But as we know, stocks would probably run a little ahead. Investors will position themselves a little ahead, and so that would probably start in the next 12 months from now.
Okay. Okay. Ayaz, the last few days, you mentioned, you referred to this. I'm actually drawing this conversation back to where we started off, which is consumption, and which is what specific pockets within consumption could be like as well. Rural recovery based plays, farm loans, etc., financiers of that nature, all showed some bit of spunk. Is this a start, and how would you go out and choose? What is it that you would choose, or what is it that you would choose to play within this, and why so?
Sure. So while we focus on always let's say, like the conversation this morning about say potential rural recovery, etc. As you know, over the last even 3-5 years, on an extended basis, most consumer companies have talked about premiumization, discretionary, starting from cars to vacations to travel, have all done quite well on a low base from an all India perspective, right? So that is quite sort of contrary and contrasting to what we're talking about this morning. Now, that being said, most companies have 30 to 50% of their business, and rightly so, because the way India is positioned, coming from the so-called rural, as we define it by NCAR or whatever, right? So it's not as if the business is tilted 70-80% or towards one particular geography or the type of consumers that we are talking about, which will change course dramatically. But a consumer which was basically just doing base level consumption, not adding, i.e., volumes, or moving up a little bit on the value chain for, say, a Unilever buying better soaps or better detergents or better shampoos, we will see those kind of positions happening. So the short answer is, I don't think there is any sharp way to play this so-called sort of rural recovery.
Okay.
If really a lot of money is there in rural India, you probably could talk about two-wheeler companies, tractor companies, which I think have a far more impactful recovery when the sentiment across the farming community or the rural community improves, both in terms of employment or in terms of getting MSP prices or volumes and those kind of subjects. So I guess that is this. The urban centric, with 70% predominantly urban and tier 2, tier 3 city kind of consumer companies of the likes of Godrej, Unilever, Marico, Britannia, etc., will have their fair share of sort of recovery trade. But yeah, it's not going to be dramatic unless we are very positively surprised where probably rural part of the business grows 20% for the next 4-6 quarters. In my current sort of sense, yeah, like that doesn't seem to be on the horizon.
Okay, but financials remain the top draw. In fact, the big story today is HDFC Bank, which has reported, I mean, the shareholding that has come out shows some headroom on the FI side. Now, lest you be confused about what's happened really, my colleague Rucha joins in to talk about precisely that and the implications or possible implications of something like this. Rucha, good morning.
Thanks, Neeraj. Good morning. So HDFC Bank is in focus today, and the FI shareholding for the June quarter for HDFC is out, which has come down to 54.83%. Now, HDFC Bank has a FI holding limit of 74%. Now, the difference between the cap and the limit utilized is called as the foreign room, and this comes at 19% for HDFC Bank. Now, talking about MSCI index, now the index requires a minimum foreign room of 15% for a weight up in the index. Now, HDFC's foreign room at 19% is higher than the threshold of the minimum threshold of 15%, and that is why there is a possibility of weight up for HDFC Bank in the MSCI index. But let's talk about how much can be this weight up. Now, after the merger, HDFC and HDFC Bank, the merger of these two entities in July last year, the limit of 74% remains, but the combined foreign holding obviously increased, and that is why the foreign room decreased. And because of this, MSCI reduced the weighting of the merged entity by half, from around 6.5% to 3.5%. And now, since the FI holding has gone down, foreign room has increased, and therefore MSCI will likely restore the previous weight in its August review, and that is why the HDFC Bank's weight in the index is expected to be at around 7.5% in the August review. Now, this can be positive for the stock, and the stock will likely rally, which it already has since the start of the trade.
Yeah, it has rallied since the start of the trade. Let's see if there is more in store. Ayaz, private banks, HDFC Bank in particular, but private banks hitherto being the stocks which people would hope to buy at value, they are no longer at the valuations that they were trading at a few weeks or months back. What's the sense here?
Yeah, so I think one thing that you and your viewers should reflect on is, I think, the share of mutual funds as of the total deposits. And I was obviously pleasantly surprised that that number, which used to hover at about 10-12%, has reached nearly 25%. And what that transmits into is what people are wary about these banks, which is the competition for deposits, because the consumer is getting slightly smarter and parking marginal savings and time deposits in the form of mutual funds. And obviously corporate treasuries were very, very focused and smart, as is in the past. And so this marginal consumers added to this tipping point where 10-12% system number has probably gone up to nearly 25%. So I think that is a point worth reflecting on in the nature of the business. The technicalities are part of this MSCI, etc. I mean, it went down because of the merger and the free float argument, etc. Stock went to 14,000-15,000, that kind of handle, and now we are at 1,750, 1,780. So I think it's attractively priced. The business is too large to ignore, and we remain quite positive in large financials.
And this is across the board, or is it banks per se? Sorry, out of time, but is it only banks, or you like the large NBFCs as well?
Banks.
And Ayaz, before we wrap up, just a quick word on the capital marketplace, because they are now in the eye of multiple storms, right? Regulatory actions happening left, right, center, happen on AMCs, now possibly happening on brokerages, or in fact has happened on brokerages. It's a great sunshine sector, but good enough to invest in?
I think so. I think people will find their way around. People have never talked about things like broking commissions, which are headed to zero and beyond, actually. So I guess it'll find some sort of floor. I don't think the business model is damaged. It could alter a bit for the discount brokers, and the full service brokers as a model is being adopted with wealth management and other services, wealth management, wealth planning, estate planning, etc., to give them more sustainability beyond the zigzag of the stock market. So I think we've seen the better part of it in the last 3-4 years in terms of trading commissions, both on futures and options and pure equities. But I think brokers who align themselves to wealth management, biggest being sort of Angel One that you flash, and you see the journey, you see ICICI Securities, which is probably getting merged. But that is the kind of direction where pure brokerages are heading to, and help facilitate consumers in their journey of wealth management.
Got it. Out of time completely on this leg of Talking Point, but Ayaz, thank you so much for taking the time out and being with us today on the show, and look forward to talking to you more often.
Thank you. It's a pleasure as always. Thank you.
Thanks. And that's it on this leg of the Talking Point, viewers. Thanks so much for tuning in.